You're on.
All right.
Good evening, everybody. Welcome back to the Library Mistakes. It's good to see it back as a library. We have been teaching here last week. We ran our course, The Practical History of Financial Markets. 20 people in the room, a new experience for the library. It went exceptionally well, and that's just my excuse to mention the course for anybody who wants to take it. It's available online. Next session, if you want to do it in person, is in London in November, but it is available online. We are now in our 10th year, and we're kind of celebrating by lots and lots of events. So before we come on to Paul, just a reminder that next week, next Wednesday, we have default, the history of the Argentinian debt default. Begs the question, which Argentinian debt default? But this is the history of the 2001 Argentinian debt default and the 16-year court case by Elliott Advisors and others to try and get some of that money back. And I have about 2/3 of the way through the book. It's tremendous, so I strongly recommend it. Gregory Makoff will be talking on that. And then after that, I know that's next Wednesday. The Wednesday after, How to Think Like an Economist. There may be economists in the room, so you might want to contribute to that. The rest of us will be educated how to think like an economist. And then you can tell me at the end whether that's a good thing or a bad thing. But tonight, we are delighted that Paul is here for his third appearance at the Library of Mistakes. And if we count our weekend of mistakes at Hay on Wise, fourth appearance.
True.
So he is a record breaker.
I know. I'm hogging the limelight.
Dr. Paul Kosmetatos is an ex-investment banker. Pauses for hissing. No hissing.
Guilty past. Everybody's got it.
Okay, well, we can all admit to something. But is now a lecturer in economics at the University of...
Economic history.
Economic history.
I'm not an economist.
Much more important, I am also not an economist.
Good.
But you can come to How to Think Like an Economist as well and see what you think.
Well, it would teach me a couple of things, possibly.
Okay. So anyway, this topic is 18th century, Amsterdam, but it's really the international linkages.
That's
and
right.
How things transferred in those days from one country to another. And I will now hand it over to you for your third, but not final appearance at the Library.
No, as long as you have me, I'll keep coming back.
Okay, over to you.
Thank you very much for skewing a beautiful sunny evening and coming to hear me, even though everything will be on YouTube anyway. But I do appreciate it. You know, we mentioned Argentina's many defaults. Of course, I'm Greek, you may have guessed from the surname. Speaking of many defaults, I think we hold the record again. But I'm going to pick on another country now. I'm going to pick on the Netherlands, which is not exactly the one that you think about being imprudent or getting into trouble. And it is really not a tale of folly here. It's more of a tale of an old system of doing finance, a brilliant old system that had worked beautifully for almost 200 years, that was finally reaching the end of its useful life. If you want to put it in a nutshell, this is what I believe. Obviously, there's only one of me. There's two authors, so I'm not two. But I did do this research with a colleague at the Federal Reserve Bank of New York, Stein Berer. We did most of the archival work in Amsterdam for this, so he should be mentioned. If you are interested in the whole story and the technical details and getting a bibliography, we have a new article that came out only a month ago at the Economic History Review. It's open access, so you don't need to pay anyone. Just Google it and you'll find it if your tastes run that way. The other book that I have put there, which you have to buy, is by our two very good and generous colleagues, Stephen Quinn at TCU and Will Roberts and the Federal Reserve as well. They are unbelievably generous in sharing their data. They are the experts in the English-speaking world, at least, of this very strange and wonderful institution of the Amsterdam Wisselbank, the Bank of Amsterdam, as it's called. And their book came out last year. And I edited with Cambridge University Press, and I absolutely recommend it. The bits that I will tell you about the Dutch financial system, that just not even the surface. I mean, it's just the varnish at the top of the surface. If you want to learn about Holland in this period and its financial system, well, the Netherlands, I should say, not Holland, that is the book to read. Okay, so 18th century Netherlands, early modern Netherlands. When you hear of that, if you don't know anything about its details, that's what you think of. Golden Age, Rembrandt, Night Watch, you know, 17th century glory days. Or perhaps, since this is the Library of Mistakes, you may think of this: flowers equating supposedly in value to a whole stack of goods, according to a 19th century journalist who wrote a book. I'm just smiling because the tulip mania among financial historians is something that we hold our cards very close to our chest. Nobody can quite know. It's a very curious event, let's just say. But we're going to go almost 150 years after the strange winter of 1636, 1637, when this happened. And we're going to talk about the 1772-1773 crisis, which nobody knows about, unless, of course, they were fortunate enough to listen to me 5 years ago when I was banging on about it. This was in the pre-YouTube streaming days, so there's only a little clip of me, so you don't know what you're missing. That was on the occasion of the publication of my first monograph, the handsome purple volume, and the reason I'm plugging it is not because I'm getting royalties, which I am not. It is because that treated the British side of the crisis. It says the British credit crisis, and it does mean it. So it sticks to that part. So what we have done here with Stein, my colleague at the Fed, who did a lot of the archival work plus a lot of the analysis, is we started looking at the international aspect of this crisis. And you will be forgiven in not knowing what this crisis is about. It's not exactly a household name. It's not 1929. It's not the South Sea Bubble. It's certainly not tulip mania. And to further throw a spanner into the works of what your expectations are, there is actually two of them, like the authors of this paper. There is one that started here in Britain. That started in June of 1772. It was a London event to begin with, but almost simultaneously it spread to Scotland, where it claimed, didn't lead it to bankruptcy, but it certainly led it to closure, the big and experimental air bank, which Adam Smith wrote about. And the ripples of that event went all across the British financial hinterland, let's just say. So there were particular ripples, interesting one in the North American colonies, as they used to be at that time. They were still for another few years, and the West Indies. Now, that's the bit I wrote a book about. And it's very interesting because it was a very intense crisis, but it was also one that was decisively contained by an action by the Bank of England, which I argue was a precursor, a very clear precursor of last resort lending that it would develop in full bloom in the following century. However, 6 months later, there was another event in Amsterdam that happened during the Christmas break of 1772. So between Christmas and New Year, there was this big crisis that claimed Clifford & Sons. Clifford & Sons was the second biggest bank in Amsterdam, and according to the press, the second biggest bank in Europe. However, I don't know what kind of measure they used. Certainly not assets, because the Bank of England should be mentioned there. But it was certainly no small potatoes. This was a very, very major bank, very ancient, in fact, predating the Bank of England in terms of life, and it went poof. It vanished. It claimed a lot of others, but like the London one, after about 6 months, this whole thing had blown over. Now, the why and the how is what this paper is going to be about. However, you see there's a big white gap in the middle of the page. The crisis, the Amsterdam one, also spread to various parts of the Dutch financial hinterland, which mostly Scandinavia, Russian Empire, but also with ripples in North Germany and also North Italy. But the bit that I'm drawing attention to is that in between, there are the troubles of the English East India Company. So this rather notorious organization, or famous, that at that time was having severe difficulties in financing its operations for many reasons. On paper, it was a very rich corporation, having very recently acquired the tax farming rights for 3 of the richest provinces of the Mughal Empire, but it had a lot of trouble monetizing this supposed wealth in London. Anyway, the East India Company got into a big problem in the late summer of 1772, when the Bank of England, who was financing its current operations, giving it a very large loan on a rolling basis. So the idea basically was that the East India Company needed cash up front to create the fleets to send to the East, pay for all its operations, and then in September it did this auction of the monopoly products, particularly Chinese tea, and made the money. So it needed basically a bridge. And that was rolling all this time for some years. It was no small amount. It was between 200 and 600,000 pounds. To give you an idea of how much that is, the whole of the paper money currency of the Bank of England outstanding was 6 million. So this loan could be as much as a tenth of that, because all these loans were done in paper. They were not done in gold. So in September, the Bank of England tells the East India Company, your credit is no good. Lots of reasons, lots of speculation, part political, because the East India Company went cap in hand to the government, got a 1.3 million quid loan, but of course at the expense of allowing the government some supervision. That was the Regulating Act that passed the following year. Now, why am I saying all that? Because in practical terms, the share price cratered when that happened. When the news went around that the Bank of England has pulled the plug, the shares fell 27% in a few days, a couple of weeks. And that affected quite a few Dutch speculators, and we'll see that. So this is basically what happens. Now, there's a lot more, but I'm going to spare you. All we need to care about here is three things. London in the summer, Amsterdam in the winter, and bits happening to the East India Company in between, right? So 1, 2, 3. Right, which brings us to the reasons for bothering you all today with this obscure crisis. Why is it interesting? What does it matter? 1772. Well, we've seen one of the reasons. There are two sequential outbreaks. It would be very interesting if they were causally connected, because that would mean that there is international financial contagion at work. And that is very interesting in terms of the connectivity of the financial system, and also perhaps because of the containment that I've mentioned that was so fast, the possibility of international lending of last resort being in place rather than just nationally, which we had in Britain. Spoiler alert, unfortunately, there is no evidence for that. But it is worth looking at contagion. The second reason is that, as economists say, and I ask forgiveness because it's a term they love a lot, it is kind of a natural experiment, a kind of a natural experiment. What you've got is two financial systems. They're connected. We know that somehow. A lot of people have written about how much and by which way they're connected. And they both experience crisis very close in time. Now, we don't know whether the cause is the same. Well, one of the reasons we're looking at contagion is that. But we can look at how they respond under stress. It's a test of institutional strengths and weaknesses. So that is a nice thing to do if history allows you, which very kindly does, especially because there is no interference by the biggest perturber and noisemaker finance in the 18th century, which is government, and specifically war. Now, you probably know enough about 18th century history. It's known as the Second 100 Years' War with France in British history. They fight all the time. And not just the British with the French, but the Prussians with the Austrians and the Dutch, and everybody's fighting all the time. But not in 1772. For once, they are at peace. There is a war, because there always is a war, but it's between the Russian and the Ottoman empires, and it really doesn't affect northwestern European finance. So this is brilliant. We have no war. We have no interest by the government at all in this, no influence, no refinancing scheme like you had in the South Sea bubble case. It's a pure crisis of private credit. So that might allow us to look at the workings of the financial system and its weaknesses and how contagion runs and all that. So it's a wonderful, wonderful opportunity to have. And finally, just to plug my previous work, we do know, or at least I do argue, that the Bank of England is an international a national lender of last resort in this period. So it is interesting to compare that kind of containment action to whatever happened in Amsterdam. So this is the motivation. Now, there are a lot of names and a lot of firms, so I have to give you a brief cast of characters. Now, the main villain, if you wish, of the story is the syndicate. It's like a mafia movie. So there's a syndicate, and it involves many different players. So on top, there is these two Seppenwolde brothers. So they are speculators. They are not fraudsters, but they are the counterparty from hell. These are the people you don't want to deal with. They are litigious. They drag their feet in settling deals. They are really annoying. But they are connected. They start from modest background in Leiden, and by the time they move to Amsterdam, they are a big deal. And they really have a lot of fingers in a lot of financial pies. And they are financed by Clifford & Sons, this very, very large bank, and its affiliates. A third player that is worth mentioning, and should have made them bold as well, is this company Abraham ter Borch & Sons. So this is a West Indies focused trading firm. So they initiate mortgage-backed securities for plantations. They do some of the trading with the West Indies sugar sector themselves. So there is, let's call it a West Indies specialist. And then there is some London associates, which will only be heard of in passing. We don't care. Then on top of that, we have a company that I've put in bold, Hope & Company, of originally Scottish origin. And they are the established, the respectable bankers, the ones who don't fail. So they are the biggest bank. Clifford's is the second. Hope's are the biggest. And they are, in many respects, the yardstick by which we will measure. They're considered the best risk, so we'll count a lot of things against what Hope are doing. Then, of course, we have the institutional players. The Bank of England, we know, the East India Company I talked about. There's also the AWB. So this is the Bank of Amsterdam. The Bank of Amsterdam is a kind of a bank, more like a clearinghouse, and I'll tell you what it was said about. There is also a host of other characters, and we'll particularly pick on Jewish metal dealers who, to their misfortune, get into this game fairly late on. Now, in terms of financial instruments, I will make the assumption that people sort of know what a bill of exchange is, because this is important. But briefly, for those who don't know what a bill of exchange is, it's an instrument that bridges time and space in import and export trade. Think of it as a post-dated check without the double crossing, so you can endorse it to other people, but not to a bank account, but to a third guarantor. So I pay you in the future, guaranteed by you who accepts it, hopefully. You could protest it, in which case a very interesting thing happens. Now, these bills are important. Of course, they're very ancient invention, possibly Italian. We're talking late medieval. They can be, of course, used for trade, and they are. They are near cash instruments in terms of cash money, although they have a maturity date and an interest involved. And they are also a credit instrument. But you can read about it. So bills of exchange are important in this case because think of them as a very short-term, unsecured certificate of deposit, something equivalent like that. A very small, short-dated date. And the important thing is that they can be protested by the purported acceptors if they don't like the credit, or if there is a credit crunch, or if there is a flight to quality, or any of those things. We have the shares of the East India Company. We have another thing in Holland, which is basically a secured margin loan. If you're a speculator and you think the East India Company shares are going to go up, you can do that on margin. That's exactly what this thing is. It's an obligatie. So it's basically you borrow the money against the shares that are going to be bought. It's 6 months, callable, and it has a margining provision. So if the collateral falls below certain levels, automatically there is a posting of cash margin stipulated. Remember those, very important. Then there is the mortgage-backed securities. I mentioned those. There is also this fantastic paper that came last year in the Journal of Economic History by 3 good colleagues in the Netherlands and Australia, in fact. So do read that. That's also open access if you're interested in these things. These are basically MBSs. So they are mortgage-backed, these long-dated bonds backed by the plantations in the West Indies, raising money mostly to buy slaves, I'm afraid. But that's the reason they were there, and they were there. We'll talk about the banknotes of the Bank of England quite a bit, and we'll also talk about the accounting currency of the Bank of Amsterdam. So let's talk a bit about, let's leave that actually for time being. Let's go there. In the 18th century, the Dutch were well past their best when it comes to actual commerce. Of course, they did still have Indonesia and would keep it all the way after the Second World War. But the glory days of being top dogs in international commerce were long gone. What they had instead, however, was a lot of accumulated capital and tremendous, fantastic, the best credit connections with everybody and anyone in Europe. They had been around for so long, originally as merchandise traders, but they had a lot of credit connections. So they made a living, a very good living for a very long time, out of either investing in British securities especially. So this is the bit that I showed you here. So these are the stock prices of the various chartered companies. I'm pointing to the East India Company here because that led to a bubble in the 1760s, but also intermediating in this business of the international bills of exchange. I had a transaction here to show you how they did it, but I was running out of time when I did my rehearsal, so we can talk about it during question time if you wish. What they were doing basically was they were intermediating in international payments, using their credit connections and earning the liquidity, ability to do foreign exchange trading, and also commission. And they made hand over fist, especially during times of war, like the 7 Years' War, 1756 to 63, where they were neutral, but basically financed the operations of the British army in the continent, in Hanover above all, because this is the Hanoverian period. Now, the Dutch had this Amsterdam Wisselbank at the center of their system. That was, so we're talking here in the comparison of the system. First of all, politically speaking, it's a good idea to compare that. London is the capital of a very strongly centralizing fiscal military state. It's not a very centralized state by modern standards, but it's strongly centralizing. The Netherlands, even at their glory days, they were famously decentralized, a discordant chorus, as Martin Prak, the Dutch historian, has called them. They had a million little governments, municipal, provincial, the States General, then there was the Prince of Orange, who had some jurisdictions. It was, by modern standards, an amazing mess. That kind of worked, actually worked quite well. In terms of central bank, and I put quotes there, centrally placed, privileged institution. Both countries had one, but there were significant differences. The Bank of England was chartered by Parliament, which gave it a lot of monopolies. They were both private companies, not state. Bank of England would become nationalized in the 1940s, to give you an idea of what kind of time frame we're talking about. The Amsterdam Wisselbank was guaranteed by the city of Amsterdam. Fine. The main business of the Bank of England was financing war. That's why it had its privileges. That was the reason. Anything else was gravy that they decided to do in exchange for the privileges. One of the things they did do was this last resort lending role and kind of oversight of the whole system. The Wisselbank was set up to arbitrage and basically take all the coin flowing in from the whole of Europe and creating a unit of account that would be useful for everyone and ensuring that trade could happen unperturbed by devaluations, revaluations, recoinage, all the stuff that really threw international commerce into a frenzy when it happened. So what they did was they collected gold, they gave this receipt system, and they created this unit of account, this bank florin. Now, technically, they did that as a full reserve bank, so no fractional reserves. I say sort of because they did eventually develop some fractional reserve banking as well, especially when lending to the VOC and other companies. But the Bank of England, on the other hand, was much more recognizable as a modern bank. It had a capital reserve and lent out mostly to the state, but also to some private business. And the way it did that was with banknotes, some coin, but mostly banknotes. These banknotes circulated mostly in London, and they were exchangeable one-to-one with sterling. So on demand, I promise to pay the bearer in band. The Bank of Amsterdam's currency was not physical. It was a gyro transfer unit of account, and it traded at a premium to coin because of its amazing convenience. What it meant was that a lot of the mercantile transactions happened through there. It was much easier to clear any kind of bill of exchange or any kind of transaction through this system rather than change coins or, well, there wasn't any banknotes to do. The system, as I say, was very concentric in the case of Britain and very multipolar in the case of Holland. And at the same time, the British, despite their imperial horizons, they were very national in their outlook, whereas the Dutch really were the engine of international finance in this period. Incidentally, when it comes to historians, the picture of centralization and decentralization gets completely flipped around. The archival record in Britain is all over the place, and you will be very lucky if you are able to match both sides of the transactions, because things will not have survived. Whereas in the Netherlands, because of the bank florin system and the gyro, everything is in these ledgers. Some have been lost, but a lot is there. So it's an amazing, amazing source. And the other thing the Dutch have is this notarial protest system, which we'll get to presently. Now, what do I mean about concentric and multipolar? I think it's worth talking about for a time. So this is a stylized look at what the British system is. It's a spider web with a very, very large spider, the Bank of England sitting in the middle. And that spider only deals with London firms around. Doesn't care about the provinces, doesn't know them, doesn't know about Scotland. All it does, it trades with London banks, primarily through the operation of the discount window. They bring bills, the Bank of England gives them banknotes. Then those London banks have correspondence relationship with the provinces in England and of course, in Scotland, and mostly deal with each other with bills. So this is the important bit. Because of everything, all the credit being centralized towards the Bank of England, the Bank of England has its hand on the throttle. By increasing or restricting, sound very familiar, very modern, how much it discounts, it can control how much credit ripples out in the whole of the system, at least in high finance. And this is exactly what it does. So this is from a previous work that I did, where it shows these fluctuations of the discount window of the Bank of England with peaks whenever there is need for liquidity, generally during panics. So 1772 crisis, you see, is the biggest spike of all, where the Bank of England basically opened the window and took all bills. Couldn't move the interest rate because of usury laws, but it credit rationed, and it did do that. Right. This is the Amsterdam picture, and I'm not going to tell you all about it because that will need another hour. But it's highly decentralized. The unshaded part is paper transactions. The shaded part is metal, which is abundant in Holland. Everything passes, well, I mean, there is dealing between the systems, but the convenience of having the FWB, what they destroy, nothing much, is such as to deal with this unit of account. Right. Okay. Let's talk about the crisis. So you've got enough background now. So what do we want to do? As I said, we want to find out what are the linkages first. Is it financial contagion, and what mechanisms it might have? We also want to know why the crisis happened in 1772 and not earlier, especially at the end of the East India Company bubble, which had happened 3 years earlier. Since speculation is such a big deal, We want to know why, how could speculators build systemically threatening positions so as to cause a crisis. And finally, we want to know more about how the crisis was contained in the absence of some agent like the Bank of England. All right. Contagion. I'm not going to go into the definition of what contagion is. It would take another hour, but we can talk about it during question time if you wish. There are basically two candidates for distress in London in June, leading to distress in Amsterdam in December. The first one is what happened in Britain. Bills of exchange. Either dishonored bills of exchange, people basically not paying when they should, default, or what I just mentioned earlier, an acceptor saying, I'm not accepting, basically a credit crunch. Both of those things happened with inland sterling bills of exchange during the London phase of the crisis. So we want to find out whether that is the case between London and Amsterdam. And the way that we do it, the way that all us crisis historians work, is CSI, I think is the best way. You know, we go and find where the bodies are buried, and then we look at them. And the bodies are buried in bankruptcy court records. It sounds boring, but it's actually not. The more litigious a dispute, the more bitter it is, the more wordy they get. And the more wordy they get, the more information is left to us. So we know about their transactions. So if there's a lot of defaults, we should be able to find something. The other place where we might find something is in Amsterdam, in the notarial record. So the Dutch had this wonderful system. When someone really protested, they went public. They said, people ask me to be an acceptor. No way. I go to a notary and I sign, witness my hand, I'm not accepting this bill. And because everything, all that is centralized, we find and we have the record. And this is what Stein did. Now, we looked at those, and it doesn't really add up. Direct litigation on defaults knocking on to other defaults, there are a few, not defaults, there is litigation, but in some big cases, but there is no clear knock-on effects between June and December. There are some big cases. Indeed, one of the originators of the crisis in London defaulted, and Hope, the big Dutch bank, was left wanting £50,000 of its money that it couldn't get back. But Hope never went bankrupt. In fact, it showed a profit that year. In fact, it took a lot more responsibility in the absence of its failed competitors, as we'll see in a little while. There are some defaults that lead to other defaults, but they all happen too late and in the wrong direction. So there are some failures in Amsterdam in spring 1773 that lead to failures in London. But that's way after the horse has bolted, the contagion horse. So wrong way and too late. Right. Then in terms of the protest record, and forgive me, this is actually from the paper, but you only care about that one line that I've seen, and indeed the bit in italics, the percentages. Third quarter, 72, which is after the London crisis, nothing much. So this is the market share, let's call it, like the percentage of London bills in all notarial protests in Amsterdam. And it's where it always has been, 5%, 6% of the market. The Dutch are much more interested in what happens in Baltics, Germany, and in the West Indies. Nothing much in the fourth quarter, but the minute a crisis in Amsterdam happens, there is a credit crunch. But of new credit to London, so again, the wrong way around from Amsterdam to London, and also in too late. So what gives? Well, there is another possibility, and that is the East India Company that I mentioned earlier. You remember those margin loans, and you remember the share price drop. Well, that's exactly what happens. So this is the daily share price. So this is from a famous data set from Larry Neal. It's almost 35 years old now, this data set, but it's still excellent. The red one is the crisis in England. The orange one, obviously, is the crisis in Holland. And in between, there is this 27% drop. And I've also highlighted in orange two of the big barriers that we see being breached in these margin loans at 170 and 160. And indeed, when that happens, the second one crashes. This is when Cliffords go bust. Right? So that's the smoking gun. These people get called for a lot of cash margins. We see that. We see that notarized. They can't find that cash. They go bust. All right? So we're all done, right? It's finished. Well, not quite, because this had happened exactly like this 3 years earlier. Exactly. When I say exactly, I do mean exactly. 27% drop in the East India Company share price. So why are we talking about the crisis of 1772 and not the crisis of 1769, right? Sure, speculators were there. They had also been earlier, rather notoriously in the case of the East India Company, so it's worth looking at what kind of speculation was happening, who was the speculating people, who were the speculating people, and also what the impact of the earlier troubles in 1763 and 69 had been. There had been already accumulated losses, not only in the East India Company share bubble, which had imploded 3 years before the crisis, but in the mortgage-backed security sector, which was already really laboring under a lot of problems. Remember, one of the members of the syndicate is one of the most prominent West Indian traders and originators of these MBSs. They, and we know that, we see that in the record, they're carrying quite a few losses. So we hypothesize, and we can't prove that a lot of the speculation in the East India Company was kind of to gamble for resurrection. But more important than that, the whole of the Dutch investment picture in this period is switching to much longer dated, much less liquid, and riskier investments. The total amount invested is approximately the same, about 800 million florins, we've calculated. But the shift, and these are just percentage shifts, goes from the blue chip and most liquid and short-term ones, minus 27%, the typical British government bonds that they would buy, minus 11%. Okay, this is a huge segment that goes down by 1/10, and that shifts to things like mortgage-backed securities, obligaties, these margin loans. So everything that is riskier goes up. In fact, the mortgage-backed securities go up by 1,100%. So there is a shift. It's much more recognizable as an asset problem that we're having here. Now, the other problem is who is the speculator, as we said. Yes, sure, there were speculators earlier, but now it's the dodgier types that are controlling most of the market. So this is the margin loan market that we talked about. And the syndicate was in the business in 1766 to 69 during the East India Company bubble. But they had about 10% of the market. In 1773, they've got over half of that market. And they get hit, don't forget, by the margin calls. Now, you would say, well, okay, why didn't the lenders increase the margin that they wanted over the blue chip stuff, which is hope? They did. It went from basically flat, 4 basis points, to 33 basis points. But believe me, 0.33% was not nearly enough to compensate for the risk they were taking. So there is, we argue, a big mispricing of risk here happening in the Netherlands. It's not more money going in a traditional bubble, like stupid money coming from outside. No, it's the same money, but it switches to riskier investment. So the question is, why? Right, moreover, just a few weeks before Clifford's went bust, we see another effect, which is called credit unraveling. Basically, it means that the creditors of an entity switch in terms of demographics. So in this particular case, we see the biggest wholesale firms, the most secured ones like Hope, moving away, stopping to lend to Clifford, but Clifford doesn't go bust then because other creditors step in. Above all, Jewish metal traders and quite a few rentiers, widows and orphans, very rich widows and very rich orphans, but widows and orphans, nevertheless. They may have been blinded by the firm's antiquity, or, you might argue, they were dumb. No, they were not stupid, I argue. By the way, just to show you, just focus on the black line. So basically, these are the average balances in the AWB. So this is where all the gold is kept, and they have this accounting currency in the last few weeks before the end. So December 31st, basically the company goes bust. So you can see this switch to smaller, more and smaller players, which is a typical thing that you see when it comes to credit unraveling. Now, as I said, I don't believe people were stupid. We're talking about Jewish metal traders, very ancient, highly sophisticated firms with an amazing ability to assay different coins, know which one is clipped. These people are specialists, they are experts, they are really good at what they're doing. But they are not very good at looking at bills of exchange because that's not their job. The Amsterdam market is defeated by its own hyper-specialization, that there are all these small firms doing this one thing beautifully, and they do it beautifully. But information cannot easily pass unless you were a bill specialist. Because of this whole thing, accept, endorse, who gets accepted. If I'm the biggest bill specialist around, I'm Hope and Company, and suddenly I start seeing Clifford's laboring a bit, well, now I know that probably is not the best idea to lend them directly, since I'm seeing their bills doing that. But the metals trader, the Jewish trader that changes coin, won't see that. Let me go back to the picture here. So you've got people like Hope, they're here. They do bills of exchange. They deal with the AWB like that. And the Jewish traders are out here, TradeCoin. They also deal with the AWB, but in a different way, and there is no information flowing between the two. Not least because the AWB is famously secretive. It will never reveal anything. People don't even know how much gold it has in its walls. So information doesn't flow. So these people can be taken for fools. Not because they are, but because they don't know. In London, instead, you have the little throttle of the Bank of England with a discount window. A great advantage of that throttle is that it's very public. It's there for everybody to be seen. Let's say I have doubt for you and your credit. I'm not so sure. So I go and send one of my agents, say, okay, stay in the banking hall of the Bank of England and see one of these guy's agents try to discount the bill. Doesn't it get accepted? Oh, it got accepted. All right. Sorry, I misjudged you. Your credit is fine. The Bank of England still takes you. You're good. So this is basically it. The Bank of England not only controls the amount, but also signals the market for who is good and who is not good. It acts as a credit gatekeeper. Doesn't always get it right. In fact, the crisis in June starts because they throw out the bill of a very prominent banker and speculator, actually, leading to panic. But we're not going to talk about this again. But it is a centralized system that can signal the market. Nothing like that exists in Holland. Right. Finally, containment. So I'll try to finish it in 45 minutes. Now, in Britain, it is the work that I have presented before here and I've written about. You have the Bank of England. The Bank of England prints a lot of paper money and comes in early and heavy and lends to these 10, 12 important bills of exchange acceptors. Its main purpose is to make sure that the bills market starts again. So the acceptors go and accept. And the way it does it, it prints £1 million in 2 days. And again, to give you perspective, it was £5 million, the whole of the paper issue of the Bank of England up to that point. 20% increase in the paper money supply in 2 days. And all that money, all of it, goes to bills discounts and specifically to these direct rescues of these bills acceptors. Now, once that's done, and the danger of contagion is gone, and the market has started moving again, the bank basically asks for its money back. It doesn't get all of it. It writes a loss of about £45,000, which it laughs off because it has unbelievably deep pockets. And then it allows the courts to do their gruesome task. And it is very gruesome. Bankruptcy laws in this period are horrific. You know, they throw you to debtor's prison, which they make particularly nasty because they're convinced you buried some money somewhere. So they make your life very miserable until you reveal where it is. Right, so it works, financially speaking. The recoveries are excellent. The Air Bank did not go bankrupt, return all the money back. Even Alexander Fordyce, the original speculator that started the whole thing, about 3/4 of the liabilities were satisfied at the end. In fact, the only one that didn't pay anything was one of the Dutch syndicate members in London, but that's something. Now, what do the Dutch do instead? The Dutch don't have a Bank of England. They don't have paper money. What they do have is fantastic credit connections throughout Europe, a almost 2-century-old ability to bring in coin and know how much it's worth and change into a lovely little unit of account, the florin, and they do that. They basically lean on the big firms. They all call in favors. They call in a flood of coin that comes into Amsterdam, goes into the AWB, creates new balances, which then they are circulated. The work we're doing now is with a specific type of companies called cassiers, which are kind of broker between the metals traders and the money market. So all this money comes in, and then the big companies take one for the team. They just absorb the losses for the good of all. Bankruptcy laws are unbelievably lenient, not just compared with Britain, compared with anyone. Of the syndicate members, okay, Clifford went bust because they had the margin calls in their hands. But the two Seppenwolde brothers, the kingpins, they didn't go bust. They didn't go to debtor's prison. They continued to operate under supervision. A bit bizarre in their case because they were not as valuable as other members of the syndicate. The big MBS issuer, for instance, Ter Borch, he was important for the working of the plantation, so of course they didn't let him go bust. The Seppenwolde is a bit older, but anyway, they did. Compare that with the brutal bankruptcy laws in Britain. So, how did the rescues happen? As I said, the coin came in, the gyros went around, the system is brilliant, it's fast, as long as there's a coin there, it's even better than paper money. You don't even need to exchange paper, it's just ledger transfer. And then Hope, the larger firm, basically steps in, and for a period of about 3 months, 4 months, basically becomes the practical acceptor of last resort, I should say. When there are people wanting bills, Hope is there to take one for the team, as I said. And we started doing this work. Actually, we have even better graphs, but they're not full yet. We're doing this network analysis of the firms before and after the crisis. And the most important thing here is to see that after the crisis, there is this big dot in the center who does work with everybody, and that is Hope. And that, for a period, the multipolar system of Amsterdam becomes a unipolar system like Hope. But Hope is not a Bank of England. It doesn't have the same pockets in terms of how much it can absorb, and it is not backed by Parliament, by a strong military state, which is then the big difference. In both cases, the system worked. Let me run through. Contagion we saw. Not what we expected, flowing the wrong way. The smoking gun is the margin calls of the East India Company margin loans. Fine. Asset risk profiles getting worse for a long time, so it's not so much the magnitude of the shock as that the structure was much more rickety than it had been 3 years earlier. The speculators were allowed to build these positions and make the structures so rickety because of informational inefficiencies, the fact that it was hard for everybody to know what's happening. The market was highly inefficient in this respect. Now, and finish with a containment conclusion that I wanted to say, which is the system worked wonderfully. As I said, in 6 months, everything looked to be back to normal. This was the last time this multipolar consensual club approach was ever tried. Now, a lot of it has to do with politics. From 1780 onwards, things go terribly south in the Netherlands. There is a disastrous war with Britain, then there is big political upheavals, and then the French invade in 1793, and bye-bye. There's no more United Provinces. But 1672, they still call the year of disaster in Holland, and it was a much worse disaster in that respect. Okay, the country was not occupied by a foreign power, but its financial system recovered. What we are arguing here is that this old early modern system, this mishmash of old privileges, old jurisdictions, this almost full reserve banking, but no specific brief, nor ability, nor willingness to step in as a lender of last resort, it had run its course. I don't want to be teleological, which is a horrible thing for any historian to do. You want to insult a historian, call him teleological. But I think that the evidence shows that the system that was adopted in the 19th century was more responsive. The reason I'm saying that is the following. I was asked by one of the reviewers when we were publishing this paper. So one of the reviewers says, yeah, all right, fine, but you're telling us here that the secret sauce in Britain was the lender of last resort. I said, yeah, part of the secret sauce, but I think even more than that is the politics of it. The Bank of England was in bed with the government. That was it. It existed because the government needed to shoot Frenchmen. That's the reason for the Bank of England. And for that reason, it had these lucrative privileges, monopoly in joint stock banking, monopoly in paper money in London, fantastic privileges. The government would not let the Bank of England go bust. It's not that its directors were cleverer or even luckier than the Dutch ones. It's just that, okay, they got into trouble. All right, well, we changed the law. You're baptized now, paper money standard, 1797. There was a run on the coin. You don't have to pay coin anymore. I changed the law. And that's basically the big difference. So the system we have is not just a central bank that we are now seeing getting, but a central bank that is like that with the government, which is what central banks do today. Let's have some questions. Enough. Thank you very much for your attention. Now I will sit. Now I am tired.
So I get the privilege of asking the first questions. First of all, wow, that was fantastic. I mean, we study financial history for lots of reasons, but one of them is to understand mechanisms. And given where we live and what we'll do today in the future, understanding the credit system is kind of key. We don't spend enough time doing it today. I know that's a long time ago, but it's a fantastic exposition of the credit system, why it changed, how it changed. My first question was really, I'm going to do a comparison with the 1920s, and you're going to tell me why I'm wrong. So the war ends in the early part of that decade. Mm-hmm. During the war, there's lots of borrowing by the states, by the governments. They issue securities. Some of them are longer-term securities. And then after the war, because this was tradition in the old days, governments used to pay their debts back. Mm-hmm. That doesn't happen anymore. So the war ends, we go to peace, they start paying it back. And you and I have been getting, let's pick a number, 5% on government securities, and suddenly that kind of so-called risk-free rate isn't there. Interest rates come down, and I'm trying to get to the stage as to why everybody starts speculating at the long end of the less liquid long end. And there's more to that in the 1920s, but that's kind of the 1920s. The Liberty bonds were there, and the Liberty bonds went away slowly. People were looking for higher yields. And then they started to go into more speculative assets. Is that what was happening to interest rates? Were they coming down during that period? Is that why people went to the long end and took more liquidity risk because they just wouldn't accept the lower yield at the short end? Or is all of that wrong?
The parallel is almost perfect apart from the interest rates thing. It's simply the availability of business opportunity, I should say, not even investment. I mentioned, and in fact, perhaps I should show the little graph that is next. The Dutch made the packet during the war by intermediating. I mentioned that. So how did they do it? You've got the British government on the left, up. You've got the British government. It has a bunch of troops in Hanover. They're fighting the French and the Austrians, and they're trying to help Prussia. Now, you don't pay troops with promissory notes. They riot, and they rob the villagers in Hanover, which is yours. You don't want that. You have to pay them in gold. So you have to find coin to give to the villagers. Now, one way to do it is send a couple of ships full of gold. A, dangerous. B, where are you going to find the coin? It's not there. It's all in Amsterdam anyway. So what they do instead is they draw a bill in Florence, So they get credit, basically, from a London banker who has connections with Holland. And then an agent, could be this banker himself, could be a quartermaster general, there could be many people, but an agent in Amsterdam uses that credit, it's still in florins denominated, right? The government has sterling, we'll get to sterling. It gives it to another banker in Amsterdam and exchanges that bill, buys a bill with a bill that is in thalers, which is a local currency down in Hanover, pardon me. And then they give that to the war supplier, who's the actual person who will get the muskets and the balls and everything. Now, at the end, that guy will need coin, because troops riot, and will give back the bill to cancel it. The banker will pay through the Amsterdam bank, the Wissel bank, in coins, in this unit of account, and then they will have this ledger transaction in London, and the government will pay down in cash or credit or whatever it wants to do, its own banker. Now, you see the different colors. That's a lot of foreign exchange. That's in one opportunity to make money. There's going to be commission and discounting income, believe me. So they do that for 7 glorious years. Plus, the British government keeps pumping out consoles. More debt and more debt, more troops, more shooting. End of story, as you say correctly. They repay some of that. But more importantly, all this lovely commission and the foreign exchange business goes away. There's no more retrenchment to shoot at. So the Dutch, it's not like they don't have interest. Interest is capital. Oops, didn't want to do that.
Just hold it up.
Yeah, it's all good. It's not like the interest goes down or up, because usury laws are not obvious in Holland like they are in Britain, where 5% is your cap and that's it. There's simply nothing to invest. It's what they used to say during the boom when the BTPs started getting repaid. They said, okay, if the Italians pay back their debt, what are all the funds going to put their money in? I mean, so they're looking for alternatives. Yes, it is yield hunting, but it's not the yield itself. It's literally a place to put your money. And having it in AWB earns nothing. Right? So in a way, net interest rates have gone down. So perhaps I can buy a mortgage bond, negotiatie, and make some money through that. So that's exactly what they did.
So the other thing that jumped out to me was the level of protestations on.
Yeah.
Well, I mean, the British ones jumped, but they were all very high. I always assume these are short-dated bills, that we are a relatively unleveraged system because of the gold standard. And yet, so what? Why is
it's not gold standard?
Okay, well, explain, why were the protestations so high, 40%, 30%?
It's an unsecured instrument altogether, so there's no collateral, right? So I think that's really the reason. I mean, you hope that the short time, and these things are up to 3 months, is going to be good enough. But as we know, a crisis is, the biggest enemy in a crisis correlation. When, people all, it's basically there is not anymore any good acceptors. There is a distrust. There is also the informational problem. I saw that a lot with Britain, is the credit crunch happened because there was no transparency who's accepting how much they're exposed to. A bill of exchange has a wonderful characteristic on the good times and a horrible one on the bad ones. And it is the multiplicity of liability. So in a bill of exchange, anyone whose name appears in the bill is liable for the full amount. Now, of course, payment will be only made once because the bill will get cancelled. But anyone will be. Generally, acceptors will be the people who are going to take up most of the risk, like Hope. But the fact that you have many names acts as a potential distribution of the risk. The problem is that in the bad times, people are potentially exposed to much more because they may have endorsed the bill, they may have accepted an old one, they don't know. So potentially everybody is exposed for a massive multiple. So what they're doing is they're sitting on money and refusing new bills because you never know who's going to come and accept me. So once the ball starts rolling, the market correlates very quickly because you don't know whether you're going to be called upon. And that's why the operation of the Bank of England during the crisis was exactly the useful one. It went to the biggest and best known acceptors and told them, here's 80 grand. If people ask you for bills, you say yes. And this is what Hope also did. They sat in the middle and they took up about a quarter of the troubled bills market. It's something called paying at their protest. We don't need to get into that. But this is exactly what they were doing.
So one final one for me. The margin lending today has got quite a good reputation because you call it, you liquidate it, you get the money quickly. Usually you don't lose money lending on margin. These guys lost a fortune lending on margin. Is that because these securities turned out to be dramatically illiquid? Is that why this form of margin lending didn't really work as well as
the lenders didn't lose all that money because, as you said, it's secured.
Yeah.
Okay, the collateral really cratered, so they lent when the East India Company shares were 218, they reached 160, so all right, so that's not too good, but they didn't get wiped out. It's not the same as a bill. And indeed, after about 6 months, you see this obligati market, it just comes back up, and the same widows come back in and they start lending. I remember we have a series in the emails with Stein, the co-writer, and it was headed The Return of the Widows. When you started seeing it, it was like a movie. They come back. It's not so much that they lose the money. The big problem was that the borrowers, exactly because it was falling down, the widows had this stipulation. You pay me 10% of cash of the principal every time we breach that barrier. So it was the discontinuity of the barrier that caused the wobble. But in the end, they sold into the selling market. Sure, they took losses, but they didn't get wiped out.
So it was the margin call?
Yeah, it was the margin call that caused the problem, or to the borrower, not to the lender. Perhaps I was not clear.
Okay, very good.
Okay.
Questions, please. Yeah, right in the very front. If you just wait for the microphone.
Thank you.
Putting the rich widows and orphans to one side, did this feed through to the average man or woman in the street? And if so, how and how long did it last?
The average man in the street in the 18th century is sadly very mute. However, when it comes to, for example, the Air Bank failure in Scotland, the one that I wrote about, it's very hard to see what happened. You read the newspapers, oh my God, it's all horrible and everybody's emigrating because there's no more jobs. But in reality, nothing much like that happens. In Holland, it's even easier because we're talking high finance here. So they are, look, there was damage. I do not dispute there was damage, but the one that we count was the Jewish community. The business community was very badly damaged. I mean, a lot of very established players went away. And it's not just the financial loss in this case, it's also the cultural impact. The Sephardic community in Amsterdam was a pillar of early modern Amsterdam, and it lost its vibrancy, not because of 1772, it didn't help that a world war was about to happen all the way to 1815, but it was definitely a very big hit. Another hit we see is that there are the outright failures of the upper crust. There are not that many. Clifford goes down, but after a couple of years, another very respected firm, Pels, says, I don't care anymore, I chuck it in. So they liquidate, orderly, no bankruptcy, so you lose another great player. It was bad for the reputation of Amsterdam as a safe haven. It was, they used up a lot of favors by calling in all the coin. However, one thing we can't say is that this was this shattering watershed firmly. It looks like one, but we can never know because only 8 years after, the politics went crazy in the Netherlands. I mean, the country was virtually in a state of civil war, and then the French came in, and that was it. And then by the time it emerged on the other side, I mean, the Bank of Amsterdam went bust in this process. By the time it emerged, it was not even a republic anymore. It was the Kingdom of the Netherlands, and it was an imperial power. I don't want to say they fell on hard times. I mean, they still were exploiting Indonesia for another 150 years. But it was not more the big financial entrepot it had been. But for the man and woman in the street, how shall I compare? Compared with the Rampier of 1672, when they had to flood the country to get the French out, and they killed, cooked, and ate their prime minister? No, it was not as bad. No, I'm not going to say that. You only have to go exactly 100 years before to find really what is still called a year of disaster.
Just in the interest of balance, that the French have been mentioned quite a few times, you should say other enemies are available.
I don't have anything against the British state did. I'm Greek. I'm neutral. That's the beauty of it. I can say all that about all these countries.
So just on that question, did you format, because the bills of exchange are the oil of the economy, how long did it take for that business to, let's say, normalise after this crisis? Was it, we talking 6 months, 2 years? When is short-term credit for trade flowing normally again? How long, as a barometer for this?
In Britain, the market gets stuck for about a month, gets unstuck, but for, in fact, I do have the graph for that. You can see the level of discounting in the Bank of England. We'll have to go back all the way, but it's not that. Since we have the actual evidence, come on. Yep, there we go. So this is the crisis. So this is just the discounts of the Bank of England. Doesn't mean anything for the size of the bills market, but it makes a very big difference because ultimately the discountability means that these things are marketable or not. As you can see, after the crisis, it just languishes at half the level it had been for years. In the Netherlands, yeah, in about 6 months, everything seems to be normal again. The market gets unstuck around late January, February, so it goes into trouble over the new year. It takes about a month, but it gets unstuck. It's mostly the long-term attrition to the big bills community. So now you don't have Clifford. Pels goes away. By the time the craziness starts in the 80s and 90s, then even Hope comes to London for a period. But that's because of the politics, because of the war.
Okay. Do we have another up in the corner?
Hi. So apologies in advance for my oversimplification here. But one of the patterns that I saw from your presentation is that a proliferator of this crisis is increased investment in higher risk securities. That seems very similar to a very recent financial crisis. What other similarities can you call out? And if there are enough, like, can you speak to why the financial community didn't learn anything from the first one to avoid the most recent?
Didn't they? I think they did. I think the system worked really well. Now, I'm going to talk more about Britain here. Well, it's my stomping grounds anyway. The Bank of England was not a formal lender of last resort. It was a company, Coca-Cola, anything, IBM. It was run for the benefits of shareholders. Okay, its primary customer was the government, and from then it got all these marvelous monopolist privileges, but it was a private company. But because it had these privileges, there was a growing opinion that the Bank of England should pay back some by sorting things out when the markets got into trouble. And in general, the directors of the Bank of England, who after all were members of the business community, they had this sense of noblesse oblige, not different to the Dutch ones as well, who took one for the team on the club. I think every time a crisis happened, even if it was a big problem or if there was success, like in 1772, it reinforced this march towards a more regulated system during crisis, towards the availability of a lender of last resort. There is a fantastic paper from back in 2012, which is called Budget for Beginners, by the team in the Bank of France, by Marc Flandreau. You see, I don't have anything against Frenchmen, French people. It's a brilliant article, and it looks at the crisis in the 19th century, 1847, 1857, 1866, and it shows this evolution after every bump of the policy of the Bank of England, how it adapts. Now, we can't quite make the same comments for Holland because the political entity goes away. I mean, still the Dutch Republic in 1772. By 1815, it's a completely different thing. And, a world war has taken place in the meantime. But I do think they do learn. I mean, people forget crises like 1772, and it falls to us to revive the memory. But I'm more charitable. I think they do learn.
We're just going to finish with one question. Can you tell us anything about Hope & Co? It's originally a Scottish bank, becomes the biggest bank in Europe. No one's ever heard of it, apart from obviously scholars of the 18th century. Any idea where it came from in Scotland? Was there a Mr. Hope?
They were the Messrs. Hope. They were like a couple, I think, brothers. I'm not the best expert. The problem with Hope is that they become quite famous in the turn of the 19th century, and they're a big deal. There is a book in English from back in 1975, which frustratingly starts after all this is done. There is a colleague, a PhD student, but he will be a colleague because he's good, who's called Patrick van der Heest. He's in Lund in Sweden, who's actually working with the archive in Hope. But you would be surprised, there's this fantastic archive, and not many people have worked there. As you said, it is the biggest bank that nobody's heard of, and actually nobody's really worked on. The book that I told was from 1975. There is a big history of Scots in the Netherlands, gallivanting around in all kinds of things. I have a colleague in Edinburgh here, Esther Myers, has written about all these people who went to study in Leiden and all that. So there is a long tradition. A lot of Scots went to Leiden because it was a university, and also anyone who had any kind of commercial connections. It was a really good idea to go and spend. It's like working Wall Street. It was the place to learn. There is a banker, a particularly dodgy person, a guy called Sir George Colebrook, in this business. And he wrote...
Actually, take mine.
Probably gone out of battery.
Probably out of battery, yeah, all this talking. So he wrote this very silly and very self-serving memoirs, but it's very interesting because he was the son of a major London banker, and he was packed off to Holland to learn how to be a banker, which he evidently didn't do very well because he was one of the biggest casualties in 1772. It was very, very shady personality, tried to corner the market in commodities. Perhaps one day I'll make a talk about him. But it's going to be there's going to be a lot of editorializing. I don't like Sir George Colebrook, but he's very, very typical on the who kind of way to learn by osmosis. So I don't want to go into the history of Hope because it's not something I know that much.
Well, we shouldn't underestimate the role of the Scots in killing Frenchmen either in this period. So,
and Irish. Don't forget that bit too.
I think we have a book here called Swords for Hire, the history of the Scottish mercenary in Europe. So usually the second son, the first son got some land, the second son went to Europe to kill people.
So. As a non-Scot, non-British, I can editorialize here and say, what do you expect? People in the poorer peripheries of an empire, they will go to be soldiers. Not all of them, but it's certainly a way to do this.
We're straying a little bit away from financial history here. Just before we finish, there are a couple of exhibits here, originals from 1720, not exactly the period we're covering today. They're on loan for this evening if you want to have a look, and to the exhibits from the bubble of 1720, kindly on loan to us. But at this stage, tremendous. Really enjoyed it.
Thank you.
Learned a lot. Paul, thank you very much.
My pleasure. And thank you very much for giving up on your sunny evening.
And please join us for a drink.